What's up, everybody? Welcome to another edition of the technical analysis series, and this is the first one, although I understand it's not my first video. So if you're new and you're starting here, well done. If you've watched the other videos and you're catching up with this one, I'm sure it'll provide immense value anyway. So as the title betrays, this one is on risk management basics. So before we get going, the quick disclaimer: neither this presentation nor anything on my Twitter, Telegram, or any other medium mode of communication, including private correspondence, constitute financial advice. I am not a financial advisor and hold no formal qualifications in this area. Trade entirely at your own risk, and this is for entertainment purposes only. Shout out to my boys, people who've helped me influence this in some way or another. Thinking USD, Trader Dante, Aurelius BTC, and Trader SZ, and those are their Twitter handles, so please do give them a follow. Right, so getting to the lesson, risk management basics. Here's how we're going to break this down. In case you're unaware, the way I usually run these sort of lessons or series is in lecture type of format, so there's no editing, it's all recorded in one run, no cuts, anything. We just kind of go through the content together and have a chat, although it's just me talking to a microphone in my mum's basement. So here's how we're going to break down the lesson. We're going to start with some general remarks, as we usually do, about this area of study. We'll then move to cover stop losses. Then we'll cover risk per trade and position size together. We'll cover the concept of R and win rate together. Having done all the mathsy stuff, we'll cover evolving R as a concept, which is Trader Dante's concept. Then we'll talk a bit about drawdown, margin trading, and then round off and conclude. So some general remarks. First one is, I anticipate that this won't be my most popular video, actually. And it follows from the fact, and this is just observation, but risk management is the most important yet least popular topic in trading. It is absolutely imperative to manage risk, because otherwise you can't trade if your account gets wiped. But most people prefer focusing on technical indicators and setups and all that, without doing the basics first. Now the second point is, I do mean it when I say this lesson covers the basics. There's risk management and trading is a huge topic, and there's lots of stuff I don't cover. I've named just a few examples here: hedging, expectancy, laddering, compounding, and all that type of stuff I don't cover here. So as with the rest of this video series, it's designed to give you the basics so you can build a working understanding and then elaborate and build on it through experimentation, further study, and so on. Another clarification worth making is that this lesson is aimed at traders. You'll see when we come to risk, sort of what does risking 5% mean, that depending on the investor's style, that can mean different things to traders and investors alike, right? So this is aimed at traders, but I'm sure the investors who want to day trade a bit can find some value in this as well. And you'll notice whenever we do some of the mathsy stuff, the calculations, or discuss these concepts, a lot of them aren't fixed numbers. There's no line in the sand when it comes to a lot of these figures. And as it says here, lots of variables come down to personal preference and good journaling or record keeping. So things like how much to risk per trade, when to increase or decrease your risk on certain setups, whether to increase or decrease your risk depending on how your trading is going, whether you want to go for high R, low strike rate versus lower R, higher strike rate, etc. All of that essentially comes down to personal preference and the information contained in your trading journal or record. And as I say at the end here, there's no point drawing nice lines if you have no money to trade. So manage your risk and stick around. So stop losses will be the first thing we cover, and we'll start with a working definition of stop losses. So a stop loss is an order to close a position at a certain price point or percentage to limit one's losses. So it kind of does what it says on the tin, right? It stops your losses after a certain point. Now I personally always use a stop loss, and I always use a market stop, because if you use a limit stop, there's a chance that it won't get filled and the market kind of jumps past your stop and exacerbates your losses. In a volatile market, especially with crypto and stuff, market stop is definitely what I use. So what's the point of having a stop? So the primary purpose of a stop loss is to protect a trader's account balance when they are wrong on a trade. Now, simple as this may sound, it is quite important. So no matter how many times a guru tries to shill their insane strike rate and so on, nobody is right all the time. And by managing risk, you can actually be wrong quite often, yet still be profitable in your trading. But using a stop loss is how you facilitate that. Okay, so I understand what a stop loss is and what it does, but where do I put my stop loss? Now I cover this a bit further in the next lesson on institutional order flow, but I can shed some light on stop placement, or at least my approach to stop placement. I usually stick to two key principles. The first is that a trader's loss, or I should say stop loss, let me quickly amend that here, a trader's stop loss. There we go, let's continue. Right, a trader's stop loss must be based on technical analysis. So that means when you're taking a trade, your stop isn't based on some random fixed percentage, calculation of risk reward, or any sort of arbitrary measures like that. Because frankly, the market really doesn't care about how much risk reward this stop loss gives you, or whether it's 2, 3, or 5% away, right? So be very cautious if anyone tells you, oh, your stop should never be more than X% or should never be less than X%. Because the market doesn't really work like that. So don't use arbitrary measurements for your stop loss and use technical analysis instead. And now the specific of the technical analysis that you should use, or at least that I use, is that your stop loss must be placed at the invalidation level. So what is the invalidation level? Well, that is the point at which your idea for entering the trade has been invalidated, or in other words, disproved by the market. Let's talk about this very briefly. So hopefully, or at least I think this ought to be the case, when you're entering a trade, you're not just randomly clicking the long or short button, but you actually have a reason for taking it. So it might be a certain support level, it might be a breakout, it might be a fib retracement you were looking for, some sort of EMA cross, whatever it may be. You have a thesis for entering the trade, right? And your stop loss goes where you know that thesis or that reason for entering the trade has been disproved. And as it says at the end, this is unique depending on the setup. So if you're trading a certain trend line, your stop would go some way below the trend line, allowing for wicks. If you're trading a certain pattern, it would be where the pattern technically fails. Similarly, if you're trading retracement levels, it would be below that. For horizontal levels, it would be where the level has failed to provide support, and so on and so forth. So always know where you're wrong when taking a trade. So you're taking a trade, this is why I'm long, and this is where that reason becomes invalidated. And that second place is where your stop placement is. So let's quickly look at a couple of examples of invalidation levels, since I know simply explaining it isn't always the case. So let's say you're trading sort of your horizontal support levels. As you can see, market comes down, gives you a bounce here, gives you a bounce here, lower high at this stage, and then when it comes down, it gives you a clean impulsive break through this level, and then you say, okay, so, and by the way, this is covered in subsequent lessons, so don't worry. So let's say you say support, support, broken, turns to resistance, and as the market starts to push away here, you decide to short this as a sort of break in market structure, support, resistance, flip, whatever. Now, where does your stop loss go? Well, if you're right that the market structure has just turned bearish and that this support level has turned to resistance, if you're aggressive, you could put a stop just above this high as it starts to reject, but a more conservative stop would, for me, at least for the start of the trade, be above this high or clear of these highs. Because if my argument, if my thesis or reason for entering the trade is that market structure has broken to the downside, and support has turned to resistance, price has absolutely no business going up here and making a higher high, right? So if it does that, I know I'm most likely wrong on the trade, and I want to be out of it, and my stop loss will limit my losses in that case. That's one example. Here's another example. This is on the euro dollar. You see the price comes down, gives you a pin here, bounces, and then technically SFPs this low, swing failure pattern. You don't even need to know the details. So let's say my argument is that this candle here, this down candle, is a false break of this low. It traded below it, closed above, and as the market starts to push away, my entry thesis is that, hey, this was a fake out, a false break, and traders who shorted below this low are trapped. So as price starts to push away, where is my thesis wrong? Well, if my argument is that this is essentially the low and it was a trap, then price has no business returning to it, or making a lower low in this case, right? So my stop would be just slightly clear of the low here. So I hope that sheds some light on stop loss placement. You develop your thesis, your reason for entering the trade, and then you think, okay, so this is what I think, but what would I need to see on the chart to show me that I'm wrong? So in the first example, it was price making a higher high. In this example, it was price going below this low. So the relationship between your stop loss and your entry couldn't be clearer. You have reasons for your entry, and your stop loss is where those reasons have been nullified. Hopefully that's clear. As much as I'd love to give you some sort of magic number or formula for stop placement, I do mean it when I say this is unique depending on the setup and how you trade. So let's jump into risk per trade and position size. Now these are two different things, and there are a whole host of misconceptions about these two concepts that you see on Twitter and other stuff. So let's pay attention here. So the definition of risk per trade is what percentage of your total equity you stand to lose per trade. Now the definition of position size is the number of units of an instrument a trader purchases. Now these are two very different things, as we'll cover in the next slide. But let's stick to risk per trade first. So as we've covered, it's the percentage of your total account that you stand to lose if you get stopped out of a trade, if you're wrong, right? So that's going to be in percentage form, and you might ask yourself, okay, well, how do I figure out what that number is? Now there's no fixed number, and this is what I mean when I said in the beginning that a lot of it is down to preference and keeping a good trading journal. Now, most traders will be comfortable between 1 and 5% of equity per trade. I used it's probably closer to 1 to 3%, but some traders are very aggressive and then sort of scale down. Personally, 2 to 3% are the most common numbers that I've seen, and I use 3% as a baseline, and I reduce it if I start getting slapped around by the market and or take consecutive losses. So that's sort of down to you. I've given you a range of 1 to 5%. You can go low or you can go above, though that would be quite extreme. And as I mentioned, most examples and most traders tend to fall somewhere between 2 and 3%. So how do we calculate our risk per trade? We take our total equity, so how much we have in our account, so to speak, and we times it by the risk percentage, obviously in decimal form, right? So in this basic example, if a trader's equity is $10,000 and they wish to risk 3%, that is 10,000 times 0.03, or 3% in decimal form, which comes down to $300. Crucially, this does not mean a trader buys units worth $300, okay? So if you're on BitMEX, for example, and you have a $10,000 account wanting to risk 3%, that doesn't mean you buy 300 contracts, right? Risking 300% means that if your stop loss gets hit, you will lose $300. So $300 are at risk, and that risk is defined by your stop loss. If that isn't clear, it certainly will be in the next slide. So we've covered risk per trade. What is position size? Well, there are two things you need to know well, actually, we define position size as well, the number of units of an instrument that you actually end up purchasing. So again, using BitMEX as an example, your position size would be the number of contracts you have taken up for a position. Now, you need two pieces of information to establish your position size, or at least this is how I do it, or one of the ways to do it. You need to figure out your risk per trade. So again, going back, what percentage of your account do you want to risk on a trade? And you need to figure out the distance to your stop loss from entry in percentage terms, right? And so the equation ends up being your total equity times risk percentage, and that sum divided by the distance to your stop loss from entry, right? So let's take another example, again on BitMEX. A trader has a $50,000 account and wants to risk 3% of their account with a stop loss 5% away from their entry. The calculation will be performed thus: you've got 50,000, which is their total equity, times the risk percentage, 3%, and we divide that by the distance to stop loss from entry. Divide by 0.05, and you see that comes out to 30,000 contracts. So risk per trade and position size are quite distinct. In this example that we just had, a trader can trade with a $50,000 account can buy $30,000 worth of contracts, or have a $30,000 position, while only risking 3%, or $1,500. So that should be very clear by now that position size and risk per trade are quite different. In this example, the trader, it has a $30,000 position while their total account is $50,000. That seems, you might think, hey, that's a lot more than 3%. Yes, but it's the stop loss that defines the risk. If their stop loss gets hit, they will lose that 3%. But that means you can effectively trade with big portions or percentages of your total account as long as you have a protective stop in place, right? That should be really clear at this stage. So hopefully, if we go back now, you can see that if you have a 10,000 account and you risk $300, that doesn't mean you buy 300 contracts. Just like here, with a $50,000 account, you can take $30,000 on a single trade and still risk only 3%, as long as your stop loss is 5% away from entry. I know this confuses a lot of people, and I should have said this in the beginning, but the slides will be in the description of this video, as they are in every video, but this is really important to understand, right? Your stop loss and your position size is not your risk per trade. That should be clear. If it's not, just rewatch this. So and pay a lot of attention to this example, okay? So for effective trading, it helps if the trader has risk per trade and stop loss determined in advance, so that these calculations can be done and the appropriate position size be taken. And just to mention at the end that most platforms, exchanges, and so on have calculators which will do this for you. Now, let's get on to the concept of R and win rate. Two different things. So what is R? R is a number which reflects the amount of risk undertaken relative to the reward of a trade, right? So it reflects how much risk you're taking to reach a certain reward, more commonly expressed or known as risk-reward ratio. So how do you actually calculate your R to get it just as a number as opposed to a ratio? Well, you just you take your reward for a trade and you divide it by the risk for the trade. Very simple, but again, let's use an example for BitMEX. A trader enters a long position with a stop loss, which is your risk, $50 below entry, and a target, so the reward, $200 above entry. The calculation would be quite simple. We take the reward of 200 and divide it by the risk of 50 to get our R, which is 4R in this example. And once again, most platforms and websites and so on will calculate it for you. If we jump to TradingView, you can see that, you know, let's say for example, you've got long position and short position tools, which are found in this part of the toolbar. Let's say I want to go short. Well, actually, let's use the example we did. So you see, you decide, you basically ascertain your entry, target, and stop loss in advance. And let's say this is my stop, this is my entry, and then my target is here, and it will automatically give you your R, provided you set this up properly, right? So the tools on TradingView will do this for you. You just have to adjust it to where your stop is and where your target is, and it will do it for both longs and shorts, and this number is our R, right? Let's hop back in here. So, lots of gurus will pontificate about a minimum R or gold standard R. Sort of, oh, you cannot take a trade unless it is at least 2 to 1 R, or 2 R in this case. Or you can't, you know, the minimum you should take is this, the maximum is this, and so on. That's all nonsense. I am yet to hear a very persuasive argument for some sort of minimum or maximum, barring really absurd numbers, right? So as long as you're being reasonable about it, as we'll see in the next slide, you can, and depending on your win rate, there's no fixed R or fixed R minimum that you have to stick to, certainly not if you are unaware of your win rate, which we will come to in a second. So as we saw in this example, in that example on TradingView, you need to ascertain your target in order to be able to calculate your R. And as with stop placement, your target should be based on technical analysis as well, right? Don't start randomly picking targets in the middle of nowhere just because it gives you a nice and pretty R, or gives you a nice round number, or makes you feel good, or whatever else, right? It has to be based on technical analysis, because the market does not care about your specific risk reward or your fancy calculations, right? Technical analysis is our guide for all of this. So that also means that the targets for a trade should be realistic. There's no point in choosing overly ambitious targets which just inflate your R or make it unreasonable, unless there are good reasons to believe that the target will be reached. So it's almost being honest with yourself when managing your risk and picking targets based on sensible technical analysis. So now that we've covered R, what is win rate? So win rate is a percentage which reflects how many of a trader's total trades are winning trades over a given period of time. So when calculating win rate, we do the following basic calculation. We take the number of winning trades, divide it by the total of overall trades in that given time period, and of course times by 100 to get it in percentage terms. So let's take this example where trader has made 20 total trades in the month of May, 11 of which have been winners. So your win rate for May, or that month, is calculated thus. You take your winning trades, which is 11, divided by your total trades, which is 20, and for the percentage we times by 100, which comes out to a win rate of 55%. Quite simple. Now, this isn't gospel or some sort of rule, but just based on observation, traders are often split into two camps, or most of their setups will meet one of these sort of categories more often than the other. So higher R, lower win rate setups. So this is where the risk reward is greater, but the win rate is lower. Or the opposite, of course, which is lower R and higher win rate setups. So where your reward isn't that great, but your trades will be successful more often. And this is the category of trade that I tend to pursue myself as well. Now this is where it gets important. By knowing your average R, you can calculate the minimum win rate that you must meet in order to be profitable. I mean, just looking at it logically without any maths, if you're taking, for example, 1R trades, or even like 1.5R trades, and you're losing the overwhelming majority of the time, you will not make money statistically, right? So let's take this. So basically, if you risk a certain amount and you don't get any payoff for that risk often enough, you will not be profitable, right? So let's look at this example here. So if a trader's setups usually have an R of 3, the win rate to be profitable would be calculated thus. So in this case, 1 divided by the sum of 1 plus 3 and times that by 100 for a percentage, and that's 25%. So if your setups meet an R of 3, so for every, let's say, for the amount of risk you take per trade, if the trade reaches target, you'll be rewarded with 3 times as much. Those setups only need to work 25% of the time for you to be profitable, right? So let's look at this table by Edgewonk, which has this specifically in this section. So here's your R multiple and the required win rate for the R multiple with the general formula outlined here as well. So as you can see, if you're taking the trades which don't have the best reward, risk reward, or R, so 0.5 R, your required win rate, it needs to be a lot higher. So your reward isn't that great for your risk, so you need to win a lot more often to justify it and be profitable. Whereas on the other end of the spectrum, if your reward is a lot greater than your risk, then it only needs to work out a certain number of times, or certainly less often, for you to be profitable. And again, whether you want to be a higher R, lower win rate trader, or a lower R, higher win rate trader, I hope I said that right, but it should be clear from this, depending on which camp you want, what side of the scale here you want to be on, that dictates your winning required win rate, and it also comes down to personal preference and the types of trades you like to take. But it should be logical to you that if your reward really outmatches your risk per trade, you only need to win some of the time, or less often, whereas if your reward isn't that much greater than the risk you're taking for the trade, you need to win more often in order to be profitable. I hope that's clear. And I'll leave the link to the sheet in the description of the video as well. So let's talk about evolving R, a concept I picked up from trader Dante, who's had webinars and other videos on this for some time now. Now, the premise of evolving R is that the R of a trade is static upon entry, but as price moves away from entry, the R of the trade evolves as well. So the point of this concept is to manage the trade such that during its course the R remains reasonable. So I'm sure you'll hear again many gurus, whatever else, tell you to move your stop to break even kind of as soon as possible, right? Which I don't think is particularly prudent, because my stop loss is where I'm wrong on the trade. I don't want to arbitrarily move my stop to meet a certain R or just for break even for the sake of it. I want my stop to invalidate my trading setup. However, undoubtedly you will have seen people advocate move stops to break even or move stops to profit as soon as a move happens, and let's look at why that might not always be the best decision, right? So this is almost a form of laziness, and where it is possible to do so, and by that I mean if you have the privilege of being able to either trade full-time or certainly monitor the trades that you do take, it's great to be reactive and respond to the price action as it develops, right? Now, an example of where evolving R might be useful, or why it's a useful concept, is the following, and we'll look at a chart in a second. So a trade travels towards target, misses it by 1 or 2 points, and then comes back to take out the trader for break even. Okay, just think about that. That retracement from pretty much the target all the way back to break even is money that the trader effectively gave back to the market. This comes back to there's no such thing as a free trade. If you let your winning trades constantly turn into break evens or even losers just because you don't want to manage it, that will really come back to bite you in drawdown when that could have been your safety net. So let's look at a chart example. If you're thinking, what the hell is this? Why is this so ugly? You have a lot of getting used to with my chart diagrams for these lessons. So let's take a concept. Let's apply this concept in practice, right? So let's say this is our trading range, the dotted lines. That's our trading range, and I'm watching it, and once it breaks down here, I want to go short. Right, it's a clean break, shifted market structure. I want to short the retest, support turn to resistance, and I figured out for one reason or another, be it you know, based on technical analysis, this is like a fib, support level, whatever, that this is my target for this short-term day trade. Okay? Now, what is the R of this trade at the moment I take it? Well, by using the short position tool, which you can find here, let's say my entry is on the retest. 1 second. Yeah. So my entry is on the retest. My stop, I would want it to probably be, at least for a start, either just above here once it's broken down, or let's say I'm being very conservative and I want my stop to be on the other side of the range, right? Forget really the technicals. We're just focusing on evolving R, so bear with me here. So entry, stop above here, that's where I know I'm really wrong. If it breaks out, then, you know, I'm probably completely wrong on the trade, and then my target for the trade is here. Now, 1.5 R, nothing wrong with that. As we can see, I only need to win 40% of the time in order to be profitable if I take these types of trades. Now, so at execution, when I execute the trade, the R of the trade is 1.5 or 1.6, whatever it may be. Now let's see what happens as price reacts. So this is my target, and let's say it's going great, and price is dropping down towards it. So the point of evolving R is that you reassess the risk reward, or the R of a trade, as it changes. So let's say this happens. Price comes down, it's going heavily towards my target, and then it reverses just at the brink without touching it, right? Let's assume it didn't touch, I didn't get filled, whatever, and price starts reversing. Now, as price lingers above my target here, and if I'm watching it, you can sort of recalculate the risk reward. Let's say I've moved my stop to break even. Okay, so I'm going to move my stop to where my entry was. Okay, and now let's calculate the risk reward as price is, let's say, here before it properly came close, or where it's around the target, right? So price is at this point here. Let's line it up with this. Okay, my stop is up here, but my reward, my target, is here. Now look what the R has turned into. It's gone to absolute crap at 0.29. But let's think about this logically. As price comes down into here, let me actually even redraw it a little bit, just for, okay. So as price comes down in my favor, and it's sort of here, and then starts to turn, you can recalculate the risk reward of the trade here. So my stop is at break even. It's at my entry, it's at break even, but the target for the trade is really close by. Now, if I don't manage the trade, that means I'm happy to let the trade come all the way back, hit break even, and sort of move on, and I'm essentially giving back 1.5 R to the market. Now, is it worth giving back 1.5 R to the market, or is it worth letting this come back on me? Well, what's my risk reward? Once price is really close to my target and starts to turn around, I am risking, right? So I'm risking essentially this. Let's draw some arrows. Arrows always help. So once price is here and starts to reverse before it hits my target, I am risking this much, a return all the way to break even, only to try to get the rest of my target, this much. Okay, let's just map this out and make it very clear. Make it a bit thicker as well. Okay, now if I asked you at the outset, do you think this is a good risk reward with a target here, or the reward here, and a stop here, most of you would say no. That being said, most traders would still be comfortable just keeping their stop at break even if it doesn't hit their target, and watching it come back and not managing the trade at all, right? So to reiterate, in much more concise terms, when you open a position, the R of a trade is static. It's fixed, as we saw here. So the risk reward specifically on this trade, if my stop's above here and my target's here, the risk reward, let's say, is 1.5, 1.6, whatever it may be, right? But once price gets close to target, at that stage, let's say we mark out this point, so price gets here, going to make this line a different color, and I've then moved my stop to break even, we have to recalculate the risk reward. So entry would be here, my stop, I've moved it to break even like a good trader, right? I've moved my stop to break even, but my target is here. And you see the R diminishes massively. Do you want to risk a return all the way back up to break even, just to have the opportunity to gain this much? Actually, it'd be here, wouldn't it? To gain this much extra space? Of course not. Because it doesn't, the R has transformed into something that's unacceptable. So how do we manage that? Well, for example, you trail your stop or you amend it. So you see the market structure is going like this. You could say, for example, okay, well, it's almost hit my target and it starts reversing. If it kind of makes a clean break of this high, I want to be out of the trade. I want to book my profits. And that's how you maintain, and so your stop moves down. And as you can see, the R of the trade becomes much more acceptable at that stage, right? So that's really what it comes down to. To summarize, evolving R is the idea that the risk reward of a trade is not a fixed number and that it changes during the course of a trade. And because it changes during the course of a trade, it warrants being analyzed as price approaches your target, and the other way around, as price approaches your stop loss as well. There's no such thing as a free trade. And in this example, as price, okay, so it's really important to note that price doesn't owe you anything. It doesn't have to hit your target. So the question is, if it comes here within a few points of your target and starts turning around, at this point, are you happy risking a return to here just to get this potential reward? Right? So we're recalculating the risk reward. Let's clean this up very quickly. So we're basically, what we're doing is we're recalculating the risk reward. So the original risk reward was totally acceptable to us. This is our entry, this is our stop, and this is our target. 1.5R, great. I only need to win 40% of the time for that to be profitable. However, if we don't manage the trade properly, and let's say price gets to here and starts reversing, we can recalculate the R of the trade and say, this is the entry, this is what I want to get to, my target, but I'm willing to let it come back to break even. And look what the R turns into. Utter rubbish, right? 0.17 in this case, I think when I've drawn it correctly. So this is your static R, 1.53 or 1.5R. Great, I don't really need to win that often, but once the trade comes close to your target and starts reversing, if you don't do anything about it, such as move your stop down or trail it or take profit or whatever else, you're essentially staying in the trade for 0.17R, which is terrible. Now it's important to note that when you do the recalculation, it doesn't need to meet the same level or the same R that your original setup has to be. So it's not really as strict when you're doing your evolving R. It simply should be used as an indicator or as a sort of wake-up call saying, hey, do I really want to risk a return all the way here just to get this extra bit? It's just a tool you should use for self-awareness and a tool for more prudent trade management. Right, I hope that's clear. No more summaries. Please do rewatch it, this part of the video, if it's confusing. Again, slides in the description, blah blah blah. Yeah, let's move on. Let's move on. Handling drawdown. So the idea that the market will at some point hand your ass to you is just about the only certainty we have in trading. Otherwise, it's all probability. So this is in fact what risk management is premised on. It's the idea that if you manage your risk well, you can take a beating, which you will, and still stay in the game and not lose all your chips, so to speak. When it comes to recovering losses, it's both psychologically difficult and then progressively more difficult to do in real terms if you continue losing. Let's take a look at this table. sourced from baby pips. If you lose, so this is sort of your drawdown table, right? If you lose 10% of your capital, you need to gain 11% to get to break even. 20, you need 20 to 25%. If you lose 30%, 43%, and you can see it gets progressively harder and harder. So this is why we try to manage our risk and avoid drawdown, because if you don't plug the hole in the sinking ship, it will only get more difficult to stay afloat. So the reason for risk management is so we don't get to these absurd amounts or percentages of loss of capital, because then getting back becomes a Herculean task. That's why we try to limit our losses with all these techniques. So there are certain things you can do in drawdown to try to mitigate it and basically stay afloat and stay alive, right? When you're getting your ass handed to you by the market, there are certain things you can look at and assess to try to limit that before you get to all those scary numbers. So here are a few of them. So the first is, can your win rate and R take a losing streak on the chin? See table 2. Now table 2 is this. This is based on sort of probability, of course, and as you can see on this axis here is the probability of seeing at least X number of consecutive losing trades within a 50 trade period. And so this is the x-axis, and then on the y-axis is the percentage, and this percentage is specifically your win rate, right? So if you have a win rate of 50%, the probability of you seeing a two losing trades in a row is 100% effectively. For 3 trades, losing trades in a row, it's 99.8%, 95.2% for 4 trades, and so on and so on. So one of the things you should do is look at your win rate, okay, whatever it is here, and then look across to see what the likelihood is of you taking a certain number of losing trades. Now, if your risk is too high, and you know you're risking crazy amounts and you're sort of martingaling or adding it, there's a chance that a losing streak will wipe you out. So this is quite nice to consult to make sure that you don't lose too much, basically based on the probability of you seeing a losing streak. But as you can see, it's some pretty harrowing stuff. Like, even with a 60% win rate, or let's be more realistic, even with a 50% win rate, right, which is quite decent, the likelihood of you seeing 6 consecutive losing trades is still more than 50%. So it's likely that even with a 50% win rate, you will still see 6 consecutive losing trades within a 50 trade period, right? So this is a nice table to consult to sort of be aware of the potential risk you might be taking with consecutive losing trades based on your win rate, and I'll drop it in the description of the video as well. There are other things we can do. So, do you have trading rules or some sort of system for taking trades, or are you gambling? Right? If you're the kind of guy who just goes on Twitter, sees someone's chart and market buys, or if you just kind of look at, you know, you saw some news or some announcement, you get really excited and you FOMO in, or you know your friend told you to buy this and you do it, then you're gambling. You're not really trading. I'm not necessarily saying you need to have some crazy encyclopedia of trading rules you follow, but there should be some sort of baseline for the type of things you have to see in price or on a chart to make you take a trade. It shouldn't be completely random, right? So assuming that type of infrastructure or those types of rules exist, the next question is, when you're in drawdown, have you been following your trading rules? Because your rules are supposedly what gives you an edge and what makes you profitable over enough trades or over a long enough period of time. So if you're not following that system, you reduce your chances of being profitable. So that's something to ask yourself. First of all, do I have rules, or am I gambling? And second of all, if I do have rules, have I been following them? Now for the next point, the virtues of keeping a trading journal really come in, and you can look at what links your losing trades and also what links your winning trades. Maybe it's a specific market, a specific asset, a specific session time, a specific time of day, a specific setup, whatever it is that links your losers and also that links your winners, you can kind of look at that and look at your trading record and try to minimize or reduce the things which make you lose trades, and try to more often follow the type of behavior that has won you trades in the past. And this all comes from keeping a good trading record. Now, more generally, do you simply need a break? Are you punting FOMO/revenge trades? You know, losing live money can be quite psychologically daunting and tiring, and a lot of the time if we miss out on a big move, or if our stop just gets taken out before the market moves the other way, it can be quite frustrating, and especially in beginner traders, lead to over trading and sort of revenge trading and so on. I stand by this when I say that apart from sort of getting hacked or drunk sending your Bitcoin to someone else, revenge trading is the fastest way to lose all your money in trading, period. And this also links back to trading rules. You know, ideally your trading rules don't let you revenge trade, and you stick to them, and you don't take a trade just out of spite. But a lot of the time, revenge trading will make your drawdown a lot worse a lot quicker, and it's worth being cognizant of as well. And the last one is something that I like doing. Have you considered reducing your risk and increasing the quality of setups you take? So that's a sort of two-tiered approach to improving or basically handling your drawdown or mitigating it. So in my case, I trade 3% risk per trade as a baseline, but if I take 3 losers in a row, or 2 or 3 losers in a row which follow my trading rules, I'll lower my risk to either 1 or 2% until I get a couple of winners in, and then I'll restore it back to baseline. But then if I lose again on 2% and take consecutive losers while following my rules, I'll reduce it then back to 1% and try to make it back, etc. All while increasing the quality of the setups, meaning you don't go for the mediocre type of, oh, this might be decent, I don't know. You wait for something very specific in price and kind of pull the trigger on it as well. Focus on survival. Margin trading. Quite a complex topic and warrants its own video, which this isn't the purpose of this video, but it's worth covering anyway, because no doubt a lot of people have been wrecked and liquidated through this means, or through these means I should say. So the definition of margin is borrowing capital from your broker to open a position larger than one would otherwise be able to. Okay? So when it comes to margin trading, the number one thing I think to be aware of is liquidations. So liquidations, or being liquidated, is the price at which your losses are such that the exchange, or your broker, will forcibly close your position. And usually your liquidation point is very clearly stated on the exchange, and there's an example there for you. If you're using 25 times leverage or margin, your position will be liquidated if your losses exceed 4%. So it's really worth being careful with, and most exchanges will sort of give you calculators and that kind of stuff to calculate your liquidation. And lots of exchanges will also, well, I suppose most exchanges and brokers will let you adjust the amount of margin you're using to avoid being liquidated as well. So cross or isolated margin, very quickly. Cross means that your entire available balance will be used to avoid liquidation. However, if you do get liquidated on cross margin, your entire account balance will get nuked, right? Which isn't good at all. That means you're out of the game. If you get liquidated on cross, you're done. Whereas on isolated margin, fixed margin for a certain position is how that position is made, and as I mentioned, that can be amended, so you can sort of reduce or increase the amount of leverage or margin you're using, and you can also sometimes add funds to stay afloat and avoid being liquidated. Now, one of the most common misconceptions about margin is that it somehow magically changes how we calculate risk. It doesn't really, right? The position size calculation does not change, the one we covered in the earlier slides. So your risk, the amount of your capital you're still risking, must still be the same. What margin does, it simply allows you to open positions at a fraction of the cost, and well, without using basically your entire account balance for that position. It doesn't somehow magically erase all the rules we just talked about on risk management just because you've cranked up the leverage, right? And as I say here, margin trading is very risky and can accelerate your losses. Do a bunch of research before trying it with live funds. So that's paper trade, demo, testnet.bitmex.com, for example. All of that stuff you can practice on there. But yeah, that's just a quick note on margin. Which brings us to the end of this lesson. So some parting thoughts. I cannot stress enough the importance of risk management. It is the backbone of any good trading strategy and what separates traders from gamblers. I do very much mean that. Unless, there's a real difference between charting, which is just drawing lines on charts, and actually trading. And lots of people love charting and technical analysis, but risk management is what basically allows you to trade and stay in the game and make money from it. Especially in crypto markets, your risk management can even be your edge on the market, given the inexperience of the average user in this space. As I said earlier, focus on survival and don't let a beating or a losing streak wipe you out, and we talked about some of the ways to mitigate that. And a recurring theme throughout this lesson has been that one of the best things you can do for risk management is to keep a trading record or journal. So you can do stuff like see what risk percentage works best, which setups are the best, what is it that links your best and worst trades, and all of this and a bunch of other information that can really enhance your trading. Both make your winners win bigger and your losers lose less. And finally, as I mentioned at the very beginning, this is a basic lesson on risk management. This area of trading warrants further and continued study. Laddering, pyramiding, or whatever you want to call it, hedging, expectancy, all of this other stuff, and in-depth margin and leverage trading, all this stuff I haven't covered. This is supposed to be an introductory document to prompt further study and research. And again, please be careful trading leverage. The day I'm recording this video is when Bitcoin dropped to like 6,800 or thereabouts, I think, and absolutely nuked a bunch of people, and long liquidations were coming in like crazy. So be careful, please. So that's all I've got. Thank you for watching. And a kind reminder that I'm building one of the most comprehensive free trading resources. So if you'd like to support my work, consider a Bitcoin donation with the address and QR code below. And happy trading, and I'll see you for the next video.